I would like to invite our entire powerhouse panel. Firstly, our moderator, Mr. Raaj Chakravarti, founder of the Bazaar. Please welcome him with a huge round of applause. Come on, we can do better than that. A brand strategist and founder whisperer who brings deep insight into investor brand alignment and storytelling that converts. Thank you, Raj, for being with us today. Joining Raj, we have our esteemed panel, Abhiram Bhalerao, partner at V3 Ventures. A warm applause for Abhiram. Joining us next, we have Shapat Parekh, co-founder, White Whale Partners. A warm welcome to Shapat. Ladies and gentlemen, up next we have Aditya Bharadwaj, Vice President, Anicut Capital. And we have Prateek Nijhawan, Managing Partner, Sail Through Ventures. Just a correction, Aditya's designation, it's principal at Anicut Capital. So this is going to be a total power-packed session. Raj, over to you.
Thank you so much. Good afternoon, ladies and gentlemen. This is almost a full house. Thank you so much for being here today. And we have some of the most, I would say, disruptive and powerful VCs around here seated next to me. And short introduction from everyone, just quickly what you do, what you run, and what kind of scope that you guys have so that we can get warmed up. Over to you, sir.
Yeah. So we run a very consumer-focused fund. It's more of a prop capital, which we manage. We do early stage to mid-stage companies. The whole idea of our thesis is to back good founders solving problems. And we've been in existence for the last 4 years. So that's more like it.
Awesome. Thank you so much. Over to you, Aditya. Short introduction.
Sure. Anicut Capital is a multi-asset manager focusing on debt and equity strategies. On the equity, we largely focus on growth. Check sizes ranging from about 3-4 million to all the way up to 10 million. Largely focus on consumer brands, but also opportunistically other technology services.
Shapat, the whale in the house, I would say. Go ahead.
So White Whale is a diversified asset management firm, Bombay-based. We have 3 distinct investment strategies. The first is early to growth stage investing. So that's the venture capital side of our business. The second is public markets investing, which is at the opposite end of the spectrum. And the third strategy is late stage investing, where we invest in companies that are 2 to 3 years away from IPO. So between the 3 strategies, we cover the entire spectrum of investing.
Abhiram, to you.
Sure. V3 Ventures, we are an early stage consumer brand, consumer tech focused investment firm. Been operating for 5 years now, but more importantly, we are a part of a larger Belgium headquartered consumer focused group called Wall Invest, which is now spent 30 years in existence. Largely come in at seed, go up to Series A with a check size starting at 500K, goes up to 5 million. So, yeah.
Thank you. And thank you, gentlemen. I hope that's enough for context. We're going to dive right in. There's a disruptor. The biggest disruptor in our world today is AI, right? And I think that's kind of changed or is kind of changing the landscape, the funding landscape as we talk about it. So there's a question for the house to start with is the funding landscape has shifted. We have to kind of admit it, right? Now, what's the biggest change you've seen? And we can start with Prateek first and go down the line. The biggest change you've seen in what you as investors are prioritizing now versus 2 years ago. We can keep it short and quick.
So I don't think so. AI has changed a lot in the consumer side of brand building. But what we've seen in the last couple of years was earlier there was a lot of things, create a brand and everything will happen. So now brand is important. At the same point in time, creating differentiation in products, creating customer love, focusing on repeat, and building a business which is for scale, and keeping profitability in mind at all point of times. Earlier it was burn money, create revenues, do raise funds, but now is a time where a lot of people see path to profitability at a very very early stage. Earlier people were saying कि बाद में देख लेंगे सब चीजें, but now people are focusing now. From the day one, they're focusing on path to profitability. So fundamentals are back.
Yeah, sure.
Yeah, so just extending on what Pratik said, I think there has been a lot of focus on capital efficiency, which means going above profitability. It's also how many turns of capital that can be it on inventory, receivables, collections, being more tighter with their payable cycles and so on. So capital efficiency is back, and founders are trying to optimize growth, by being capital efficient. That's one significant change that we have seen in the last 24 months.
Wow, so that's like you're moving towards late stage than early stage, I would say. That's where Shapat, you being early stage as well, where do you see this?
No, so I echo what both Pratik and Aditya said. I think capital efficiency is extremely important. Gone are the days of sort of growth at all costs. You need to build more sustainable business models. So that's number one in terms of the change in the environment. The second is obviously we've been through a brutal funding winter. And what that has resulted in is that investors are taking a little bit more time, right? And now, specifically when you look at the consumer sector, one, deals are obviously taking a little bit more time to close, but also the time gap between a typical seed stage investment and a Series A investment has elongated. So what that means is that it's taking more scale today to actually get to a Series A stage, right? By which time, I think a few things emerge a little bit more clearly. The first being unit economics, the second being product market fit, right? So I think investors are looking for early signs of scalability. Within the consumer investing ecosystem, there's a clear realization that, look, and this could be a generalization, but specific to a few subsectors, it's not very difficult to get from 0 to 50 crores in revenues, right? A little bit of capital and a good set of evangelists, consumers can probably get you there. But the real challenge ends up being how do you scale from 50 to 100? So as a result, you're seeing funding rounds get delayed to slightly higher scales.
So you're waiting for people to like kind of mature, the brands to mature, get some product market fit,
Yeah.
and then kind of put the money in.
Yeah.
Abhiram, are you also an early stage consumer investor? So
Absolutely. Completely in agreement with what Shapat said as well as what Pratik alluded to. It's taking a while for companies to get Series A and B funded. So we are seeing an interesting time for us where there's a lot of deal volume still at the earliest stages of funding. So you will still have founders come in at seed, sometimes pre-seed stage to raise capital, and there is appetite for them because investors are thinking, hey, why don't I come in early, take a large share of ownership in a business where I have a strong thesis and I can potentially help the founder build out their journey to Series A. At Series A and Series B, it's taking a lot more for companies to get funded because investors now have become extremely wary of profitability, of product market fit, and it's a trickle down from what's happening in the public markets, right? Over the last 3 years, whenever our equity markets have grown, it's largely been profit growth versus revenue growth driven growth in the market. So if public market investors are chasing profitability, that will trickle down to, because these are the largest investors in a lot of the venture firms or PE firms in India, right? So I think there's a lot more focus on profitability. And as a result, there are very few companies who do end up crossing the Series A, Series B hurdle. These become extremely attractive for the growth as well as P stage investors. So we are seeing multiples actually expand for Series C, Series D rounds because there's very few companies and a lot of capital chasing high quality founders. So it's a very interesting phase we are in.
So I have a question to just kind of shock. You had something to say? Sorry.
No, I would just like to add to what Abhiram just said, right? I think we are seeing the one big point that I guess all of us missed a little bit was that we're seeing more rational valuations today at sort of the early stages, right? So it's certainly a better environment for us fund managers to be deploying capital. This is going to be a great vintage to be deploying capital because, the companies that you're backing today are much more sensibly built in terms of unit economics. Capital efficiency is at the core, slightly later stage, so a lot of the early stage risk is out of the equation. And to top all of that up, you're getting, to enter at more reasonable valuations.
You read my mind. So my question was to everyone, we can just take a quick one, is where's the risk capital then? Like if you see in consensus, we are all talking about, you said, capital efficiency, you said turns, how many times you're talking about later stage, you're talking about, you did allude to a little bit of seed, but where does that leave the early stage, the guy with a vision, with a thought, with a deck, he's not got product yet. Where does that, does he have to, go sell his house? Sorry.
So when I was sharing that particular thing that what you mean, the risk capital is in the path to profitability. We're not looking at profitability right now, but we're looking at path to profitability. That means that there is capital efficiency, there is the money which is being spent. If tomorrow if they stop spending that money, would they be able to survive for a longer period of time? So there is a risk capital at the early stage because there is, at that point of time, there is a burn which is going. There is chances that the company the capital can dry up and can shut. So the risk capital will remain, but eventually founders should be focused on facts that if the capital is stopped, whether I will be able to continue the journey for the next 3 to 6 months, ride the wave, and then come back to the market.
Pratik, I understand that. Just sorry, countering this, there's a lot. I'm a founder, so I know how difficult it is, how much, and I think others will agree. There's a consensus out there on LinkedIn and everywhere else that early stage, which was, betting on someone is kind of drying up, and everyone's talking about, hey, build it out, come back to me. Do you agree that that's the stage? I'm not disagreeing with your model. What you said also means that, you have to. You're talking about how efficiently that money can be used, but that money has to be there in the first place for it to be, to reach that level. Do you guys still think there's risk appetite? Anyone with a vision, anyone wanting to do something really disruptive, coming into you guys and saying, hey, this is a plan, will you fund me?
So for us, we've never been super early stage investors, but that being said, I don't think that appetite for very early stage investing has really gone down because there's a different cohort of investors and that ecosystem has always been very robust, right? So I think that ecosystem continues to thrive. I think what we are talking about is sort of the areas that we play in, which are slightly later stage.
No, absolutely agree. Just wanted to know what your opinion was on it. Yes, please, Aditya.
Yeah, I think, what's changed, Raj, is that euphoric disruptions are no more being funded, right? There is capital for early stage, but along with capital, there is also a lot of rationalism to see if this capital can get you to the next milestone. So think of this as you're driving a car where you have, let's say, X liters of fuel, and you have to get to the next bunk, right, to sort of fill it up, right? So earlier, it was like, I have to get there as fast as possible, which means you're not talking about other factors, which is speed, etc., economy and stuff. Right now, it's about, you going in a pace so that you reach the bunk rather than, running out of fuel in the middle. So
no, absolutely appreciate that. So crazy, but yes, I mean, more rational crazy is what you would say, right? Abhinav, you had something.
Yeah, I just had one counterpoint. Although risk appetite at Series A, Series B stage of investing has gone down, what we've started doing as a fund as well is started coming in earlier in spaces where we know there's enough market depth, where we identify high quality founders and there's a very strong thesis fit in what the founder is building. So incidentally, late last year, we launched a seed program at V3 where we are now backing founders building only in beauty and personal care businesses in thesis areas where there's a high conviction as well as a lot of comfort with the founder, and we've started deploying capital there. So we've now made our fourth investment from that strategy, and we're working with founders to build the business out the right way, and as my colleagues pointed out, to make sure that the capital that they raise at a pre-seed stage helps them get to the next stage of funding at least.
Just, just for the seed thing, you need to be good at pickleball. Is that where the choice is? Like you get chosen there. So you need to play your game well there, and then you get a seat at the table. Sorry. So I'm gonna now double down straight in. So this question's for Aditya and Prateek, both of you. Others can also take it, no hard and fast. It's just that at the very early stage, I'm just going to talk early stage for a moment. I'm sure there's a lot of early stage founders or even people who dabble in that. There's not much data, right? And so what's that one thing that gives you conviction in a new founder or a business or a concept or a product, whichever it is?
Yeah, so I'll take the liberty to say two actually.
Please, please.
I think the first thing is insight, right? Especially if you're at an early stage. And look, we are also sort of going there, trying to assess what's changing in the market, what kind of behavioral trends will pick up and stuff. So I think what we're looking for is that one insight, which is like a wow insight, which I have not thought about and which can really, you can make a business out of that insight, right? I think that's the most important thing that we look for. The second thing, which is again, by no means second in terms of priority, is that our assessment of whether the founder has, over and above all the stakeholder management, will he be able to also manage the fiduciary responsibility because he's taking an external capital now, right? So, which means not only should he be cognizant that, look, I'm going to put in my money, and at some level, it's also a sense of experimentation, right? Because there is an insight, but you don't have outcomes out of it which are measurable. So, but he should also be cognizant of the fact that he's doing it with, the investors' money. So he has to be doubly sure of that. So these are two things that we look for.
Aditya, did the fiduciary thing creep in lately? I mean, being, what we've seen around.
Not really. Not really. It was always there. But then, what happens is, like I said, right, times of euphoria, you do forget fundamentals at times, but then, it was always there.
So you don't want them to get the camellias to the camellias first. Okay. Prateek, you.
So for us, the most important thing is we focus, as I said, the market has to be large enough and the founder market fit. So at early stage, these are the only two things which we look at. Large market is what we try to assess from our end, how it could be. And then we spend some time with the founder to figure out whether this founder is the right founder for scaling in this particular market. So the founder, and then comes then whether he will be able to succeed is what we figure out. So large market, founder market fit, and we probably would cut out a check.
I have a question for both of you gentlemen. Is there a bias towards someone who's come from that industry? Let's take an example of lots of people are getting funded who've come from Q-commerce. Like you spent some time there, so I know the space, I know the game. I'm doing a vertical, easy for me to. Does that play around? I mean, I'm actually okay to hear a yes as well.
So if you ask me, yes, right? See, because what happens is that you go in with the belief and the assumption that the person who comes from an industry has or knows the brass tacks of it, right? So there is a bias, but then that bias will be tested, right? So that bias will be tested, meaning which you will not take it on face value and move with it, but then, yes, you will.
So that helps.
You'll assume
That's
it's
an
true
edge.
and then test it.
That's an edge.
That
play
is
with.
an edge.
I'll give you 2-3 examples in terms of people who've come from the same industry have done extremely well. Both are three examples from Fireside's portfolio. One is Boat. Aman came from JBL. Amama Earth. Varun came from a FMCG background, I think Coke. Third, Vadam. Vadam had a tea history around his family side. So that thesis has worked a lot because they've got prior knowledge of working in a large organization. They know where the problem is. They're able to they know what consumers want and what these large incumbents are not doing for the consumers, because these are also big machines. It's very difficult for them to change. For these guys to come in, figure out what the consumer wants, and to place themselves there is easier. So I think there is a bias, and as Aditya said, that would be tested in our discussions, whether it's not that everyone from quick
But
commerce
they get the
is
first check at least for it to be tested. That helps. I'm absolutely okay with that because they do come with a, I would say, an industry specific fit, if you would look at
A
it?
lot of times when very young founders come, there is one advice to them is work for your competition, spend some time in a large organization. You're good, you've got that skill, spend some time. Maybe you will figure out that what I'm doing is not the right thing, I'll rather work with an organization. If not, then come back in the market again.
But I'll take an example here, which is completely a different polarity, of course. I come from an entertainment background. I don't know if you look me up. I am a cinematographer by profession, earlier avatar. So I know the space very well. And there's a slew of vertical TV, OTT platforms, if you've seen, coming out. Each of them are led by an IIT, IIM guy based out of Bangalore, far away from the epicenter of where the action is. And trust me when I say this, I've spoken to many of them. They do not know how a shoot is done. Yet they're running these organizations. So is that a contrast to what you're trying to say? Like, should you at that point, but they're getting funded because they come maybe with they speak the language probably. What do you say there? Is that an aberration or is that a...
No, that's the difference between necessity and sufficiency, right? So is that so let me put it this way. Is prior experience necessary? Perhaps yes, right? Because it helps you. But is that alone sufficient? Probably not.
Okay, so domain knowledge helps. So there are different criteria. Anyone else? Shapat, you want to take anything quickly on this, or I'll just move forward? Yeah, anything to say? So I'm gonna go deeper into this. At the growth stage, we've got this question written down, is what makes you double down? And I'm going to ask Shapat and Abhiram this. What signals do you look for to write a second or a third check, considering that you are in that space most of the time, Shapat?
So we typically, like I said earlier, we typically don't get in at very early stages, right? So by the time our comfort is established, companies have achieved product market fit, they've achieved a reasonable scale, 25 plus crores at a minimum in revenues. By that time, the unit economics start, showing up a little bit more sensibly. So even our first check, in a sense, is a slightly late stage check.
So the noise dies down, basically. That's
so I think that the signals there are a little bit different from early stage, right? That's the beauty of investing. I think you have expertise to be built in sort of every stage of investing. At the stage at which we participate, the three things that we focus on the most are clarity, execution, and brand building, right? So let me elaborate on each of these. Clarity, we're looking for clarity in the founder's mind on, one, a clear understanding of his business model. Trust me, there are lots of times when you don't actually see that. A clear understanding of the customer segment that he's chasing, a clear understanding of the problem that he or she is trying to solve, and a clear marketing communication around how to solve that problem, right? Your product or your service, the marketing communication around that needs to be very clearly focused around, building relevance to your customer segment, whoever that customer segment is. So that's number one. And these are maybe a little bit, sort of softer elements that we're looking for. The second is execution. So we do also like experienced founders, but by the time we invest, the prior experience is one thing, prior to them having actually started the business that they're running. But what's actually even more important is how have you executed since you've incepted the business, right? And there we try to get into the DNA of the founders, where we're looking for clear signs on, look, there's a clear sort of focus on building businesses more sensibly. Unit economics is at the core, right? How have you sort of faced capital shortages? How have you done your capital planning over the past, right? All of those factors play a big part in execution. I think execution is probably, in our minds, one of the most important moats that a founding team can have.
Rightly
right?
so, because that does differentiate from...
particularly in India where you see things coming out from left field all the time, right? So I think being able to adapt to a changing environment is extremely critical. And the third is brand building, right? So like I said earlier, I think a focus on product and sales can probably get you through to that 50 crore journey. But long-term great results are really only formed by founders who are very focused on brand building, right? You need to build a brand. And that has to be a clear realization. And that, again, is a DNA thing, right? A lot of times, founders know how to scale businesses up. They know the right channels where the products will sell. But how are you going about achieving those sales? Is it purely a discount-led strategy? If so, will that stand the test of time? Question mark, right? Are you selling on channels which allow you to actually build a brand, or these are just quick channels which will allow you to build scale, right? All of these are very important signs on sort of the ability and the mindset of founding teams to be able to build a brand.
No, agree completely. I think the differentiator which you mentioned last, the brand building bit, I think a lot of CEOs and I see founders take it upon themselves to build the brand. I think, example, Board, he kept himself as a CMO, right, Aman? And I think Samir does all the heavy lifting. And I think that's fantastic the way it's scaled up. I think that's a lesson most founders should ideally take up. Abhinav, I have a question for you. This is a little different from... You work very closely with founders because you are also very, very early stage and you've done a lot of early stage. What separates a pitch that excites you from one that's just well rehearsed? And it's a very nice question because we know of founders who actually do this, spend hours rehearsing it. And first is, how do you make out that it's, and your thoughts on it?
I think the best pitches are those where there's no pitch deck involved. And we now have 15 companies in our portfolio. I wouldn't have seen a single pitch deck from all the founders we've invested in. And this is primarily because, A, we start engaging with founders a lot of times before they're thinking of starting the business. B, we've known the founders for a while, and hence we have that kind of a relationship with them before we even choose to invest. But C, it's a lot of thesis-driven investing, which is where we go out and look for founders who strongly align with our thesis. But coming back to your question, I think the one thing that separates a good pitch from the others is how well the founder is able to tell their story, right? And that's the most underrated aspect of raising capital is, are you able to tell your story to the investors, right? Because no matter how good a product you have, no matter how strong a brand you're building, if you're not, or no matter how good your business model is, right? If you're not able to explain it to the person sitting across the table, it's going to be really hard for you to raise capital, especially in an environment like today where investors want all the tick boxes checked before they write a check, right? So I think super, super critical to get your story right. And as Shapat alluded to, right, getting good product market fit, having strong brand equity, showing prior execution does help ease the decision making for the investor. But if there's no story, if you are not able to sell your story, if there's no narrative around the entire fundraise, I don't think you'll be very successful at raising capital.
So Abhiram, one meeting is enough for you to sift through this, look through this?
I think one meeting is enough for us to get a good sense on whether we like the founder or not, for sure. Most of the time, it's more than enough for us.
Pratik, will you take this as well?
So for me, for us, we'll come in very, very early.
Sorry, Pratik. So this also has the fireside bit of yours into it. So because you guys have also done a lot of early stage, that's the reason.
So as I said, so the second check is where we only look at a couple of things, which one we look very, very closely at the founders who are able to drive a lot of, I would say, drive repeat. So if they're able to do that, we're in for it. Secondly, as Shapat said, how well they're looking at brand building. So if they're focused towards it, I'm not, so as he said, 0 to 50 crores can come through great performance marketing, selling on platforms. How the founder is thinking about building his brand during that period, because while we are interacting after the first check which we've given, so that gives us a lot of confidence in terms of cutting out the next check. Repeat, customer love, and the third is how he's thinking on brand build.
Okay, so you took the other one. I was actually alluding to you. How do you look at a founder when he comes in with a pitch deck, or how do you sift through that?
A lot of our pitches also happen without a pitch deck. Pitch deck is more to do. We ask for a pitch deck at the for our cursory review, but eventually, I think all our investments have been done without a pitch deck right now.
So is that a message to lots of founders sitting here saying, hey, you can ditch the pitch deck and just start building the product?
You do a pitch deck to get a Zoom meeting, but on a Zoom meeting or a personal meeting, you don't bring the pitch deck out. But till the time you want to show something across. Earlier, what used to happen is the pitch deck, founders were reading through the pitch deck, so the emotions do not come out.
But this is real gold. You know why I'm saying this? Because if you look at people who don't have access to, like, you all and hearing from you, I think they have this convoluted vision in their mind that I need to build a deck and spend a lot of time on that deck. And I see people spending months and without even looking at the product. I mean, and this is fantastic.
Deck is good to get a meeting.
This is fantastic.
But on a meeting, you could just be natural.
Aditya wants to
add something, right, to what both Abhiram and Prateek said. So I think deck is actually an outcome of what you're thinking, right? Because essentially this is especially in early stages, it's a business of belief, right? The investors need to believe that you'll be able to execute that, whatever you're presenting. One thing that's worked as well, at least, something that I personally prefer as well is written memos. Right? So if you write, let's say, 2 pages, that speaks way more than what, 20 slides of
what they do at Amazon every time. Like, they don't have presentations, they don't have
Absolutely.
text, they just have memos,
Yeah.
right? But I'll just counter that for a second. Lots of in the circle, memos are still not very common. So it's, I appreciate the fact that you do that. But, I've seen that as a founder, and I'm countering this for a reason, because I'm sure there are many who will take this as gospel, but there's still a lot of VCs will still insist on a deck. It's just, that's where I'm saying. So I'm just cutting through the noise and trying to get to where the actual guys who make a decision, who's on the stage today, this is what they decide, guys. This is where we kind of shapat.
We're a bit old school, though. We do ask for a deck.
Oh.
At least to go through the deck to understand the business before actually even getting into a first
But
meeting.
at your stage, it'll have a lot more metrics to which is visible, which is needed for you, right? Because this is basically an more numbers deck.
At our stage, if you don't have a deck, you're not well prepared.
So because that's showcasing.
And the MIs.
Yes, MI. That's
Exactly.
It's a reflection of that, I would say, right? Let's take this forward, guys. I'm just gonna. I know this is against process, but if there's any question that really needs to be answered, please raise your hand and shout and scream, and we'll take that in between as well. Sir, please. You have a question? Yes. Do we have a mic for him? I've been told to keep this at the end, but I believe this is more relevant to do this in the middle.
Thanks, Raj, for doing this in the middle. Just a quick question, because we haven't touched valuation yet, though. So in terms of, let's say, more early stage investments, where you don't have the numbers yet, you don't have the figures yet, what are you looking at in terms of valuation, and how do you come to an agreement with that, and what would be the advice to founders when it comes to valuations?
Do you want to point this at anyone in particular, or the entire?
No, all
please,
experts
quickly,
there,
guys.
so.
All of you can. It's an interesting, actually, point, right? Because TAM, SAM, SOM, I think that's what you meant as well?
I can take
Abhiram,
that. I
please.
think a lot of the early stage investment journey is more an art than a science, is what we always say. And the valuation is an outcome of that. I feel there's no one right way to value a business as early as at a pre-seed or a seed stage, right? And there's really no metrics for you to put down and do a DCF or whatever it is to arrive at a valuation. So it's a meeting of minds between the founder and the investor. It's also a function of the amount of capital that the founder needs at that point of time, and what kind of dilution is fair for the founder as well as for the investor at that stage, right? It's a combination of these 3 things. I will say now that at Series A and Series B, no longer gone are the days where businesses would purely get valued on revenue multiples. Investors are now triangulating what would the EBITDA or the net profit of a business look like had this business been operating at steady state with operating leverage, etc. And then triangulate the revenue multiple with an EBITDA multiple that makes sense for the industry based on public comparables, etc. Right? So I think valuations have become a lot more rational, especially where there is a lot of data available to make a decision. But at the super early stage, like pre-seed or seed stage deals, a lot of that is driven by quality of founder, amount of capital needed, and how much capital the founder is willing to dilute at that stage. And when we are seeing pre-seed deals happen at $8 million, $10 million valuations as we speak, even today, right? So it's all a factor of those three.
Anyone else wants to quickly take this?
There's a mental framework which I read somewhere, right, where it said you take a. I mean, this is more relevant for founders. Is that you take a business that's, let's say, at a large scale, which is probably the end destination, what you want your business to be, and you sort of work backwards to see how much of capital you have to raise, and then split them into different milestones across, let's say, different stages. That'll give you a sense of what your valuation should be at each stage, right? So it'll be a factor of, like what Abhiram said, it'll be a factor of dilution plus the kind of metrics you'll have to show. But I just thought I'd share this because this can be a mental framework for you to build to see where your company will fall and how much of capital you'll have to raise in totality across the journey. So that could be.
What's important though is for you to grow into the valuation before the next round. And that's where most founders are getting stuck today. In the euphoria of 21 and 22, a lot of founders ended up raising extremely overpriced rounds, and investors, a lot of them due to FOMO, due to the euphoria around the funding environment at that stage, did enter companies at extremely high valuations. A lot of times the business fundamentals are not able to grow into that valuation, which is why you're seeing a lot of flat rounds and down rounds, which really affect not just the founders, but also the other investors on the cap table in terms of dilution going forward, right? So really be mindful of the valuation at which you raise capital and ensure that you're way in the money by the time you want to raise the next round of funding.
Abhiram, doesn't the market also dictate how much or how big the game is in terms of valuation should be?
Yeah,
Wouldn't that be?
Absolutely.
So if it's a growing large market, I think valuations automatically will scale up, right?
Not just that. I think the deal metrics or the deal specific situations also dictates. At the end of the day, a price is where the demand curve and the supply curve meet, right? Correct. If there are a lot of funds chasing the same deal or the same founder, then there have been situations where valuations do move up and the highest bidder wins. But at the same time, we've seen founders are sensible enough to understand what value the investor brings to the table and not just the valuation, right? So I think, look, it's a deal-specific situation, but...
Does that help you, sir? Awesome. Moving forward, we make this go a little crazy. You guys have $100 million in your bank today, sitting with you now, as I give it to you, okay? And where would you invest that? Let's take it one at a time.
You have your checkbook ready?
Yes, sir. It's already sent to you. Where would you invest now? And that actually alludes to a question which was designed to be there, is like what categories or consumer behavior are you looking at? So if you had carte blanche and if you didn't really had to answer to an LP, where would you put that money? Keeping in mind that you're looking at a return, keeping in mind that you're looking at, a pot of gold at the end of it. Let's just take it that way. I'll start with Shapat on this, if it's possible.
So I know it's a consumer forum, but I guess, if I had a blank checkbook, where I would invest in today would actually be higher education. So, frankly, we're not sort of thesis-driven investors, but I've always had this thesis about higher education in India. I'm taking a wild guess that most of us here are sort of in the 30-plus age group or 25-plus age group. Few of us are much older, but if you think back to the days when most of us went to school and were applying for colleges, right? What India was back then to what India is today. So at that time, I'll talk about my own experience several years ago. When I was going for college, I was sort of one of two people in my entire school of 160 that was going abroad. The same school today has a good 10-15%. I come from a small town. 10-15% of the students going abroad, right? The reason for that is twofold. One is that today, spending power is incrementally more than, what it was back in the times that I went to school. And number two is that, you look at any aspect of consumption in India, it's grown multifold during that time period, right? The one area which has actually not has been higher education. You know, I know a lot of new universities have opened up, but they're few and far between, right? One Ashoka and a few others, which are top notch, are very, very difficult to get into still. So the one area of consumption that has really not grown in decades has been higher education. So somebody needs to put up big capital to fix that issue. That's a golden opportunity. It needs to be done right. It needs a lot of very, very patient capital.
And it's aligned with the growth of the country as well. So I think that's
absolutely,
exactly.
absolutely. And you know, if you think about it, that's the one area of consumption that every parent will gladly spend on.
Yes, absolutely.
Right.
So
they
it's
just
the
don't have the
consumption
avenues
story
today.
at the end of the day as well, right? So, Pratik, would you? Sorry, Aditya, please.
No, I think one of the themes that we are quite excited about is also healthcare.
You have $100 million,
right? Yeah, I mean, there's a lot to do with that, right? You can do a lot with that. So I think healthcare is a very interesting theme to go behind. A lot of problems to solve there. Starting with just the inadequacy of beds in our country. Again, that's a very consumption-driven theme. Growing population, also part of the population is aging. Then you have statistics like the diabetes capital of the world, blah blah blah. So so that's a big theme to go behind. A lot of problems to solve. That's one. The second thing I think is a lot of supply chain is changing, right? Thanks to things like quick commerce, people's habits changing, right? A lot of supply chain changes are. I mean, that's something that we expect will keep evolving in the next few years. So I think. Yet again, there, you'll have a lot of problem statements to go behind. So these are two themes that we are quite excited about.
No, that's crazy. Pratik.
I think we'll still do consumer. So we'll back founders because that's the only thing which we understand well. So to make as you said, to eventually make that return also.
So then a space in that where you would want to double down on, or if you had the money and you'd say, okay.
We will continue betting on founders because that's something which we don't know which space to invest. We don't have a broad thesis in terms of this is a right. We love to hear stories from founders. They educate us in terms of this is a growing category because they're young founders who come and say this is what is selling. This is what people want. That's the insights what they get from maybe in BPC, maybe in food, maybe in any consumer side. So we will continue betting on founders who are going to build something large in the consumer category, and that's all about it.
Abhiram, you want to take this?
Yeah, I think we still are very bullish on the consumption wave in India, and I think 60% of our GDP is accounted for by consumption, so extremely bullish on it. What we think is going to change over the next 10 years or so is there's going to be a very new class of brand consumers that's going to start engaging with new consumer brands going forward. 100 crore Indians have access to smartphones. Roughly 85-90 crore of them have access to the internet, right? But we only had a 7 to 8% transactional volume of customers. That is now moving to a 15-16%, and thanks to supply chain disruption through quick commerce, a lot of consumers sitting outside the tier 1 cities, in tier 2, tier 3 cities are now starting to transact with digital first consumer brands. As always, fashion is the first category that goes digital, as was the case in Web 2.0 or 1.0 for India, right? And soon you'll see beauty and personal care brands, health and wellness brands, nutrition brands, snacking brands being built digitally, but for the Bharat consumer first. And this entire Bharat consumption story is going to see a large uptick over the next decade, and we're really bullish on that.
I'm going to slow down this and puncture the balloon for a minute. We're talking red flags. We're talking red flags as in what are the red flags that, that kind of strike you when you are talking to a founder, about a business. Which are the ones that you look for that will stop you and say, okay, no, I'm not going to take this conversation ahead?
A lot of founders we meet, they say there's no competition. They don't acknowledge their competition. So I think a little bit of paranoia is very, very important in founders. They should whenever they're pitching, they say this is the thing which we built, and there is no competition around. So I think very, very important for a founder is to study their competition, acknowledge that competition, and focus their journey around that. So
Cool. We'll make this a little snappy. So Aditya, if you...
I think we expect the founders to be really on top of the metrics, right? What drives the business, and these necessarily need not be financial, like operational, and being a little cagey about metrics or unsure sort of puts us also on.
Or gray, you would say, not knowing
not
enough.
being very clear about it.
Sure. Shapat?
Yeah, in fact, I was going to mention the same point, but one more is a lack of focus. So if at a very early stage, you're starting to dabble into multiple things, it just demonstrates that you don't have conviction on your core business, right? Particularly when you start talking about international expansion very soon. We're all focused and excited about the India story. Why do you need to, at a very early stage, go abroad? So.
And many brands have burnt their hands and fingers and their entire bodies and come back. Abhiram, your...
Saying not knowing what the biggest risk to your business is like super critical. There's a question we ask all our founders, what keeps you awake at night, right? And if they're not able to answer that question, that's the biggest red flag for us.
Oh, that's philosophical as well. I mean, I was thinking of more... Okay. Okay, so there's a big TV staring at me saying time's up. I'm going to just take one last and then we'll open it for a few minutes, sorry, to the audience. I'm sure you have had an entertaining session. One last question. Sorry, it's just more like an advice. If you were, all of you, advising a founder preparing to raise in 2025, what's that one thing that you would ask them to get, definitely get right?
I already said it, get your story right.
This is important for all of us.
You have to sell what your business is, and as Shapat said, right, clarity. It all boils down to that, right? If you don't have the clarity to explain exactly what your business is, what are you building, I think you're going to have a tough ride ahead when it comes to fundraising.
Awesome. Ambiguous as always, Abhiram, but yes, worth it. Shapat, is there anything that you want to add to it? That one last bit, saying what would you advise? That it's the same question for all of us.
Build for the long term. There's a fine line or a fine balance that you need to strike as an early stage startup between near-term growth and what you're really building for, right? Your ultimate vision. So don't lose sight of that at a very early stage.
Wonderful. Aditya, any thoughts?
I'll just say, focus believe your instincts. Don't ask investors for advice. Believe your instincts and convince them rather.
Wow. That's a nice one. Aditya, please.
They've said everything across, but build consumer love. So for any consumer brand, it's very, very important to build consumer love, create repeat. That's something which you will have to continue doing it, and the capital will follow.
So we've actually got a exhaustive, from one end to the other. There's philosophical answer here. There's consumer there. In between, there's metrics and numbers. I'm opening this floor to yes, please. We'll make this a little snappy, but yes, please. Let's start with you, sir. Would you also address who you want the answer to, or you could just give it to the panel?
Yeah, directed to Abhiram because it's just a follow-up from the previous question, but anyone can answer. On the early stage valuation and the check size, where do you as an investor decide to draw the line in terms of dilution of equity so that when follow-on investors come in, it's reasonable enough for them and the founder doesn't lose enough equity that they lose interest in the company itself? So because there's no valuation.
Absolutely. I think very valid question. I think there's two ways to look at it. I think number one, as I said, is a factor of quality of founder, amount of capital required, and finally dilution, right? Which decides the valuation of the business. I would say if it's a founder who brings really strong pedigree, is a second-time founder who's been there, done that, building in a business where he's already operating, right? Like the examples given by Prateek earlier. The founder is bound to command a higher valuation at seed, which means he has the ability to raise more capital than any other founder starting up would, right? From the investor's point of view, you would want to get enough skin in the game so that because of investor coming in at a pre-seed stage is very different from an investor coming at a seed stage, right? The amount of hand-holding, heavy lifting done by the investor, and we do get involved, we do get our hands dirty with our seed stage founders, right? We are involved right from deciding what the name of the brand is how the product will look like, to helping them find manufacturers, helping them find a design agency, etc. All of that needs to be remunerated or rewarded in some way or the other. So the investor will ask for, say, a 10-20% equity ownership upfront in the business, given the amount of heavy lifting done by the investor. I'm guessing at the end of the day, it's a meeting of the mind, as I said, right? But it's also a function of what value an investor brings to the table.
Was that helpful for you? So, if you could also do a quick introduction, what you are, what do you do, what your name is, sir? It'll be nice.
Myself, CA Aninda Ghosh. I am a May 90 CA. I was for 16 years with JSW, 5 years as CFO.
Okay.
Two group companies. Now I am heading the projects in SRMB.
Okay.
Projects, internal audit, costing, etc. And investment. Basically, my question is, last session we saw Wells Fund and the biggies, mostly. So here we are finding the next gen, the young, the bright ones. Now, coming to the success, the creation of the success story. What is the thing where the VCs are, is it that VCs are giving way to the big players? Like the big players are coming and winning the whole domain. Is it like that? Because we saw Flipkart and this whole coming up. Then everything faded almost. Flipkart, Amazon, and then again, all the stories were created on the board, but things were diminishing, fading away, and the biggies have started grasping the whole thing. So what is your prerogative? Basically, I'm asking Abhiram, but it's to the panel. How do you think, because last session we had the Wells Fund. Now Wells Fund is Wells Fund. Here we are having you. So where do you see the difference for today and for the future?
So, summarizing this, anyone understood this? I think it's about... Sorry, Pratik.
Your question is regarding large players coming in now and smaller players eating up the smaller players?
Okay.
And how far this will sustain, or how far you can sustain, the new players can sustain, etc.
I think it's the survival of the fittest.
Large players are large. They have a position there, but this is a time where smaller players are disrupting the larger players. It has been there is a start of the journey. Now I see, when I look at brands, the younger generation does not want to wear stuff which older generation wears. So even brands are thinking through that. How do I get into? So I used to wash my hair with a different shampoo. My kids do not want to wash their hair by that shampoo. So they're looking at younger brands. So this is a time where younger brands are going to come in, and there's a disruption from smaller to larger organizations.
Pratik, I'll just quickly give an example. So I'll give you an example, and that'll probably answer your question. Great example been trending lately is mattress. So if you really, the Wake Fit story, but Duroflex has actually been forced to introduce Sleepy Cat. So I think that story comes in. So there are older people who have to change colors and become smarter, bright, to attract a newer audience. I think that's where it is, right? Anyone else, sir? Thanks for your question. Last question. We have a last question. Anyone wants to fight over? Let's give the lady a chance, I think. Sorry.
I've got the mic, sorry.
Oh, you got the mic. Okay.
Yeah. That's what founders do.
Oh, awesome.
Right. So, hi, my name is Rohan. I'm a founder of a multi-millet snack brand called OG Snack. I've been taking notes and waiting for this session since morning. So I have a couple of questions, starting with Pratik. Pratik, you mentioned that you guys keep an eye on a large market cap, before investing. And at the same time, a contradiction happens to me when I have noticed this, that whenever we talk about a bigger large cap, the investors come back to us saying, but there is a lot of competition as well. So how should we tackle or answer this? Every large cap will have more competition.
So large markets, clear product differentiation. So if you've got a product which differentiates through positioning, through product, through community, through distribution, you can challenge those answers. So tackling as you said, large market is good because you've got we've got a chance to scale the business there. And if you find the right differentiation in your products, you would be able to succeed.
Right, but there's always a level of differentiation that you can have in everything, right? I mean, you cannot make a huge difference in everything. So is that acceptable, or you still need to go above and beyond?
Small differentiation. In your snacking brand, we've got a portfolio company which is into snacking. He's challenging Haldiram. So it's a brand called Let's Try. The only small differentiation he did was he removed palm oil to groundnut oil. And his whole claim to fame is, I sell groundnut oil. I sell snacks in groundnut oil. In cookies, he's removed maida to atta. That's it. So small differentiation and you would be able to, and it's a large market. Snacking is a large market.
Great. My second question is actually for you, Sampath. When you kept on talking about 0 to 50 CR is an easier journey, and then 50 to 100 is a task. I mean, for an early stage startup like ourselves, even 0 to 50 CR is actually a long journey. Question being, is 0 to 50 CR with visible repetitive loss on the balance sheet is appreciative, or 0 to 50 lakh with a break even or very low loss is more admirable?
No, so first of all, I don't mean to diminish the effort that it takes to actually, first of all, even get the guts to start a company, right? And then to scale it from 0 to 50. My point was more around, relative scale and where is it harder to build. So, the 0 to 50 stage journey is challenging as well, of course. I think what's important, at least for us as investors, is again, unit economics, right? So we like to see, we're okay seeing modest growth. We're not chasing superlative growth. We're looking for modest growth, but we're looking for early signs of unit economics making sense. When you talk to a different cohort of investors, they might have a different viewpoint because, particularly in categories which are very large, there is merit to actually overfunding a company sometimes to create a very large outcome, creating that first mover advantage, which itself becomes a big moat, right? In a lot of overfunded or rather competitive categories, funding by itself is a big moat. So the viewpoint will be very different depending on the kind of investors that you're actually targeting.
I also have an attached question
Sorry, is this a quick one? Because
yeah, it's a quick
there's
one.
People waiting for us.
Right, it's a quick one. Sorry.
Okay. They can chat with you later if you want. I just want to give this to that one lady who was raising her. I fought for you. Please make this relevant. Come on, quickly. If you want to come up and shout your question out. Come running to us. Because I don't think by the time the mic reaches you, you'll reach us. Yes, they're all here. Yes.
Smudge AI. We make personalization tools for beauty and wellness brands. I'm early stage, so my question is for Abhiram. How risky is it for me to answer when an investor asks me in a pitch, how do you see your brand 10 years from now? How risky is it for me to say I see an exit or I see an acquisition? Because everybody says build for the future. I'm 2 years into the business, and I think my future is a good exit. Am I putting myself at risk?
It's a very tough question for me to answer. I think from the founder's point of view, if I were a founder, the answer I would give you is be honest to yourself. There's nothing wrong in building for an exit or building with a vision at some point, because there's nothing wrong for founders to be driven by monetary outcomes in the longer term. And this is something we've been very clear about. And we've seen great examples of founder exits, right? Mamaearth with Varun, as well as recently with the Minimalist acquisition, right? There's nothing wrong. If that is a right decision for the business, it is a right decision for the founders. And at that point of time, it's a meeting of the minds between the founders and the investors on when and where to exit, right? So I think nothing wrong with that. From a fund's POV or for an investor, if you were to ask me a question, would you back a founder who's building a business for the long term or back a founder who's building a business just to get acquired in 2 to 3 years? I would prefer the founders building in the longer term, right? So it's, again, like if you're super early in your journey, right? So we don't even ask, To be honest, we don't ask founders, how do you think about the business in the 10-year period? All we care about is how will you execute over the next 6 to 12 months, right? That's all you should be worried about.
It's a derivative anyway. I mean, how you exit, whether you get sold, whether you IPO.
Absolutely.
Ladies and gentlemen, it's been a very, very fun session. Thank you for your patience. Please, a round of applause for everyone. And thank you.
Yes, I must say, quite an insightful session. So much to learn from this. So huge round of applause for them. Come on, give it up for them, please. We have a small token of appreciation for each of you, requesting Hazel from CMPL team to please come on stage and do the honors. Firstly, Raj. A huge round of applause, ladies and gentlemen. Give it up for them, please. I can't hear the claps. Yes, come on, give it up for them. Next, we have Abhiram. Thank you, sir. Next, we have Shapat. Aditya. And Prateek. Let's close the session with a group photographs. Ladies and gentlemen, please note we're going to have our next session begin in the next 2 minutes. We're just going to get the stage set.